Here in Orange County, we are seeing two very different markets. And sellers are either saying, hey, let's get packing. Moving truck is coming in 2 weeks. And some sellers are saying, no rush. I'll just get to packing in a couple months. Now, which market do you fall in? Let's jump into that. Hi, it's Brooks Marr with MMG Real Estate Advisors, here with our December 2023 market report for Orange County and an update on the Federal Reserve, inflation, and mortgage rates as we head into 2024. Now, if you find the information in this video helpful, be sure to hit that like button as it helps us a ton. And if you don't want to miss our next update, be sure to hit that subscribe button. So like I said before, it's a tale of two markets. The Los Angeles Times notes that Southern California home values near record highs despite borrowing costs. CNBC highlights how home prices continue to climb despite surging mortgage rates. Yahoo Finance delves into why the current housing market favors sellers. However, these headlines paint a picture of the general market, not specifically the luxury segment. Today, the luxury housing stands apart as a distinct segment, differing significantly from the overall market dynamics described in these articles. These headlines create confusion by portraying a robust housing market across all price brackets, yet they overlook the luxury market entirely. This distinction is crucial. The housing market comprises two distinct segments, luxury and the rest. Luxury housing, encompassing the top 10% of closed sales with homes priced above $2 million, experiences sluggishness. Weekend open houses don't witness a flood of potential buyers, and multiple offers are not as prevalent as in the lower price ranges. It's not uncommon for a luxury home to go for a week or even weeks without a single buyer touring it. In this realm, buyer competition is not as intense. Now let's go over the Orange County market data. In the past 2 weeks, active listing decreased by 6%, with a drop of 129 homes, bringing the total to 2,180, the lowest since May. Last year, the inventory was 3,182 homes, 46% higher, or 1,022 more. This decline marks the second largest drop this year, aligning with Orange County's trend of reduced housing activity during the holiday season. December typically sees fewer homeowners listing their properties for sale, and many unsuccessful sellers withdrawing their homes from the market to enjoy the holidays, delaying their real estate plans. This trend suggests that the inventory will continue to decrease significantly until the end of this year. Now, for demand. Over the past couple of weeks, the snapshots of new pending sales dropped from 1,173 to 1,113, marking a decrease of 60 pending sales, or 5%. This decline brings December's demand to its lowest level since tracking began in 2004, aligning with last year's subdued levels. However, unlike typical end-of-year plunges, the current decrease isn't as drastic due to inherent buyer activity throughout the year. Despite the season, there are always buyers in the market, explaining the steady but low levels of demand. Expect demand to reach its lowest point at the start of 2024, but anticipate a quick rise in mid-January, marking the beginning of the winter market. Now, the past couple of weeks, despite both supply and demand decreasing, the expected market time for Orange County properties remains steady at 59 days. Comparatively, last year's expected market time was slower at 84 days, and the pre-COVID 3-year average was 87 days, both slower than the current pace. Now, in recent weeks, the luxury housing inventory for homes above $2 million dropped by 4% to 745 homes, with a decrease of 31 properties. Luxury demand also decreased by 6% to 133 pending sales. Consequently, the expected market time for these luxury homes increased from 164 to 168 days, making its highest level since January. Now, this time frame emphasizes that the luxury market operates much slower than the lower price ranges, requiring careful pricing and significant patience. Now, the luxury market data comparing year-over-year data, luxury demand has surged by 22% with an increase of 24 pending sales, while the active luxury listing inventory has grown by 7%, adding 47 homes. Notably, last year's expected market time for luxury homes was significantly slower at 192 days compared to the current market pace. Selling luxury homes requires a patience as the pool of potential buyers is limited. In the luxury housing market, despite a buyer-friendly atmosphere, prices typically remain stable even during market slowdowns. So, what is our advice to sellers across all markets? Success in selling any property, including luxury homes, hinges on a seller's motivation and willingness to price their home accurately based on its fair market value. Determined by analyzing comparable recent sales, motivated sellers who adapt their asking price tend to fare better. Now, to stand out, sellers must offer the best price, terms, condition, location, and upgrades. When you combine that with a strategic market plan, your home will stand above the rest. And buyers, it's simple. During the holiday season, buyer demand decreases, and so your competition decreases as well. Inventory is still low, and so your options will be compared to normal years. The question all realtors get asked is it a good time to buy a home? And all realtors say yes. But why do we at MMG Real Estate Advisors say yes? You can afford the home, it makes sense currently for you to move, and you want to do it. Now, if you don't feel it's the right time for you, don't move. And if you are unsure and have any questions to help you make that decision, we can provide all the information possible to help you make an informed, confident decision. Now I'm going to pass it to Christopher with a rundown on the Federal Reserve, inflation, and mortgage rates.
Thanks, Brooks. As we close out 2023, we have heard many predictions for the housing market. Some of them are still echoing from 2022, but none louder than its complete collapse. This narrative has been pushed aggressively on social media platforms to generate clicks, views, and shares, which the algorithms love and allow doom and gloomers to monetize these types of posts. Yet, the housing market continues to show resilience, largely because of low inventory. As a result of homeowners enjoying a strong equity position and having locked into low interest rates of 3, 4, and 5%. Now, these ultra-low mortgage payments would allow many homeowners to rent their homes with a positive cash flow if they needed to. Just another reason there's no urgency for homeowners to place their homes on the market. Clearly, there are some headwinds for the real estate market going forward, such as an affordability index near historical lows, resulting from record appreciation since the summer of 2020, which is only exacerbated by the Fed's tightening of monetary policy to rein in high inflation, by which they have aggressively raised the federal funds rate 11 times, totaling 525 basis points or 5.25% since March of 2022. The Fed's bias towards higher interest rates until inflation subsides, and their inflation target rate being 2%, was all it took to push mortgage rates to a 23-year high, above 8% this year. Inflation has been stubborn, but has come off its high of 9.1% in June of 2022. Keep in mind, CPI, or headline inflation, includes more volatile items from a basket of goods that includes commodities like food and energy, unlike core inflation, which excludes them. Now, the November economic report showed the CPI, or Consumer Price Index, a closely watched inflation guide, increased 0.1% in November and was up 3.1% from a year ago. Energy prices decreased by 2.3% and helped keep inflation in check, as gasoline fell 6% and fuel oil was off 2.7%. Food prices increased 0.2%. Now, the Fed's decision to leave the Fed funds rate unchanged for their third straight meeting, along with their outlook for 3 rate cuts in 2024, had an immediate impact on lowering mortgage rates. It's important to note that 30-year fixed-rate mortgages have come off this year's highs, as you can see in this snapshot of rates on December 14th. The Fed's dot plot chart is projecting a Fed's fund rate of 4.6% by the end of 2024. The Fed dot plot chart shows the dots where each Federal Open Market Committee member thinks the interest rates will be by the end of the current year or 2 to 3 consecutive years after, and the more ambiguous longer run. If you have any questions about anything said in this video or something you may have read online, feel free to drop us a comment or give us a call, text, or shoot us an email. We're here to help you navigate the home buying or home selling process and be a trusted resource that you can rely on. If you feel there is someone you know who can benefit from this information, well, then give it a share. And until next time, Brooks and I want to wish you a happy holiday season and an amazing new year. Thanks for watching, and we'll see you on our next video in 2024.